Welcome back to my channel, guys. Okay, so a new video for you this week. We're going to be talking about hedging. So first of all, what is hedging? There's a number of different ways that you can hedge, but we're going to concentrate on one particular element or one particular strategy or approach. Okay, so hedging is where, just say for example, you were long on the DAX, just as an example, and you were in a negative net position, so it gone against you. Well, you could hedge that by trading what's known as a safe haven instrument. Okay, now the most popular safe haven instrument is gold. So what you would do was, this would all be to do with the news, by the way, okay? Now you know my strategy when I scalp that I don't use the rhetoric, I don't use the market sentiment, and I don't use the news, okay? I just simply trade my patterns. When we talk about hedging, we're talking about an intraday, or we're actually talking about a swing. So what we have to be looking for is, this is not something that you do every day, or every week, or every month. You might do it maybe once every couple of months or something like that. Because what you're looking for is, you're looking for some kind of major news, okay, some major catalyst, okay, major sentiment, major rhetoric. You know, it could be, I don't know, an airline has gone bust, they've gone into liquidation, or it could be, you know, Elon Musk has pulled out of a company, something like that. So that is a catalyst, okay? So that actually drives futures. So for example, Apple, there is not many companies that have the ability to influence futures. There's only a few stocks that can do that. Now Apple is one. So you can imagine, just say for example, you know, Apple brought an item out and, you know, had a major fault or something like that, you know, hypothetically speaking, of course. Well, that's the catalyst, that's the news, that's the rhetoric, okay? So you can imagine if you were long on the Dow, for example, and there was a major sell-off because of that news, because there's no fear in the marketplace. What you would do is, you would look to go long in gold. Now the reason for this is, gold is known as a safe haven instrument, and it has been for many, many years, and it will continue to be. Physically, and we're talking about digitally here, okay, more so. So what you would do would be, you would hedge your position on the Dow against gold. So you could be long on the Dow. You've went long, you're holding a position, you're now in a high negative net position because this major catalyst has came out. What are you going to do? Are you going to sit and wait? There is things that you can do. One way to make profit while you're waiting for that, or liquidate and take a loss, it's up to you, is you can go long in gold. Okay, so as I said, the major banking institutions and the major hedge fund companies will take their capital out of stocks and futures and various sort of instruments, and they'll redirect that capital into gold. Okay, now it depends on the position. You know, if you're only you know, slightly down, you might decide just to liquidate, say, your Dow position, take the loss, get out, and then put your capital into gold. Or you might decide that you want to hold it. So there is a number of ways that you can do it. Or you could be in a situation where you don't actually have a position on the Dow, that you've just seen this market sentiment, this catalyst, and you've seen this massive sell-off. You might not have a position, but you're still indirectly hedging against the future, because when you see that future have a massive decline because of a major catalyst, the money will pour into gold. Now, not only does it happen with stocks and futures, it also happens with foreign currency as well. So for example, Forex, the principle is the exact same. They'll take their money out of Forex into whatever pair. The most popular pair is cable, which is the dollar versus the pound, and vice versa. That's known as cable. And they would take money out of that and they would put it into gold. But you don't leave it in there. So what will happen is when the market recovers again, so i.e. when the future recovers, gold is going to come back down again in price, okay? Why? Because what these major institutions will do is they've moved their money into the safe haven instrument, okay? I mean, the word safe haven explains everything, doesn't it? So if these major banking institutions and hedge fund companies are doing this, there has to be a reason. And there has to be a reason why it's called a safe haven instrument. Well, this is the reason. So they will put their money into gold, but then when the market starts to recover again, they'll liquidate that position, take the capital, and then go back into the futures again, or the stock, or whatever. So when you trade against futures, you're not going to hold this gold for a long period of time. You're literally capitalizing on the major pullback that's happened on the future. Now that future will recover again, so this is why you cannot just sit and hold this position. This is not how it works. This is not how hedging works. When the future starts to recover again, what will happen is gold will actually decline in value. So when the future is declining because of the major catalyst, what will happen is gold will start to go up in value because the safe haven instrument is being used, okay? But what will happen is when the future starts to recover, all the capital will be taken out of gold, so the price will decline. So this is why you can't just sit and hold and wait, because you could end up in a negative net position. So it's literally working like this. Now this doesn't happen all the time, okay? This is not something that you do, as I said, every week, every month. You might only do it like 2-3 times a year. But it's a fantastic way to hedge. And as I said, you don't necessarily even need to be in a position to hedge against the future. Okay. Now the principle of hedging is that you're covering a negative net position. Okay, so that's what hedging means, is that you're covering a negative net position with this other position that is going to go positive. Okay, but that's a direct hedge. Okay, you can also have an indirect hedge where you're not long in the future, but you see this opportunity, so you pour your capital into gold, and then it comes back down, you take it back out, and then you move it back into whatever. So it's a very good way to capitalize, okay? Because we hear about buying the dip, yeah, buying the dip or selling the spike. This is another way to capitalize or to hedge against the future. And as I said, it's something that you just got to watch out for. So my advice, keep an eye on gold. What you'll see is when there's a major catalyst, it could be a war breaks out or whatever, there'll be a massive sell-off. But what you'll see is you got to keep your eye on gold, because when this massive sell-off takes place because of this major catalyst, it will start to increase. So keep your eye on gold. So what I would suggest is, don't go in with real money with this initially. Try it a couple of times in demo so you can understand how it works. It's absolutely fascinating to watch. It's absolutely fascinating to watch. You see the future decline and you see gold rising, and then when the market sentiment returns to a more positive marketplace, you'll see gold do this. So it's a very interesting and very exciting way to make profit off a decline of a future, because gold is the safe haven instrument. Remember that. Gold is the safe haven instrument. It's the #1 go-to for all the major banking institutions and hedge fund companies. Okay, so give it a try. For the rest of the year, what are we in? We are in April. Keep an eye on the marketplace. Tell me going forward at the end of the year how you got on. It's a very, very good way to hedge against the future. As I said, you don't necessarily have to be in a position. So if you are in a position and there's a massive pullback for whatever reason, and you're going to hedge gold, well then you are directly hedging against that future. But if you're not actually in a position, you can indirectly hedge against the future. You're not actually covering a short, you're literally just buying gold because of the current status of the future. So Hopefully that wasn't too complicated for you. It's very simple actually. It's very simple. Do a little bit of research on it yourself. It's something that I've been doing now for probably about 2.5, 3 years, something like that. But as I said, it's not something that you do all the time. So anyway guys, hope you enjoyed that video. Hopefully it was, hopefully it gave you some kind of education, or you found something interesting, or you found some kind of value out of this video. So next video I'm going to do, I'll do a video on stacking. If you don't know what stacking is, watch this space. It's also very interesting. Okay, so but before I go, make sure you smash that like button. Make sure that you subscribe to my channel for more videos like this. And if you want to message me, you can message me at sambora.00. That's my Instagram. You can also follow me, keep up to date with what I'm doing. If you want to join the Sambora trading community, DM me on my Instagram, or you can send me an email, eduardosambora@yahoo.com. Last 3 videos, very exciting, full-time traders. We've got more coming up. We continue to evolve, and we continue to innovate. So I hope you guys enjoyed this video. Next video, stacking. Here we go. Have a good day.